Hello and welcome to the fourth part, should we call it episode, of accounting for assets. In this part, final part, we will address issues around asset derecognition. So derecognition is when you remove an asset from the books. Why? It happens when either control is lost or no further future economic benefits are expected from the said asset. So essentially, it ties back to the definition of an asset. An asset, remember, is a resource controlled by an entity from past events from which future economic benefits are expected. So if the entity no longer controls the asset, derecognize it. If, let's say, no further economic benefits are expected, it's no longer an asset, derecognize. So we derecognize assets when either the asset is sold or it's classified as being held for sale, or it's exchanged for another asset. The new asset gets recognized, the asset given up gets derecognized. Sometimes the asset might just be abandoned or scrapped, or the rights to benefits expire or are consumed. So this will relate to the right of use asset for leases. Once the rights to use expire, there's no more right of use asset remaining. Now, it is important for us to distinguish derecognition from impairment. Impairment is when the asset continues to be recognized, but only the carrying amount is written down. In comparison, when you're derecognizing, you're actually removing the asset entirely because there's no further economic benefits expected. Looking at derecognition on disposal, you will remove the asset from at its carrying amount, the asset removed from carrying amount. That's a bit wonky. The asset is removed at its carrying amount. Now, when you're derecognizing a depreciable asset, you have to keep in mind that you want to first update depreciation expense to the date of disposal. And then when you're derecognizing, you credit the asset at its cost and debit the accumulated depreciation. All right. So we don't just net out the two numbers. We don't just credit the net book value, the carrying amount. We want to remove both the asset at cost and the accumulated depreciation. The consideration received is measured at fair value, and any difference is recognized as a gain or loss. Sometimes there may be partial derecognition. So that happens when a part of an asset is disposed of or replaced. So think about an airline company. The engines of aircraft, they are major components, and they tend to have useful lives different from the rest of the aircraft. So let's say if the company is replacing the engine, because the engines are sizable component, at the event of replacement of the engine, the old engine gets derecognized and the cost of the new engine will get capitalized, right? So the assets that are accounted for using components approach will result in partial derecognition. The remaining portion continues to be recognized on the books. So as an example, if, as I said, for the aircraft, the old engine would be a component. So the old engine gets derecognized. The new engine, the new component, is recognized as a new asset. And the result is to avoid double counting of benefits. Now, this also will result in a future change in depreciation expense. So depreciation will need to be reassessed when derecognition or partial derecognition occurs, to make sure that the cost allocation is done based on a systematic allocation. Sometimes you can have derecognition without any proceeds. That's when the asset is abandoned or destroyed, essentially walking away from an old mine. This doesn't have any resale value. So essentially what happens there is you write off the carrying amount. So for depreciable assets, credit the asset at cost, debit accumulated depreciation. If the asset did have any positive carrying amount, of course, writing it off means the result will be a loss, which is recognized in income, in P&L. Sometimes assets could be exchanged for another asset. So the exchange involves derecognition of an asset given up, recognition of the asset received. So the asset exchange is considered as a disposal, not a continuation. The transaction value depends on whether the exchange has commercial substance or not. Commercial substance is said to exist if the entity's future cash flows change significantly due to the exchange. Now, we say that happens if the risk, the timing, or the amount of cash flows has become significantly different. So in a sentence, an exchange or a transaction is said to have commercial substance when it results in a significant reconfiguration of the risk, timing, or amount of the entity's cash flows. Now, assessing the commercial substance matters because it will determine if fair value should be used or not, whether resulting gains or losses should be recognized or not. And essentially, the attempt is to prevent an recognition of artificial income, right? So when no real gain or loss has actually taken place, if there is no commercial substance, we do not recognize gains. So consider first an exchange with commercial substance. So remember, an exchange is a case of derecognition. You want to make sure that if you're exchanging a depreciable asset, you update depreciation to the date of the exchange, right? Make sure that depreciation expense is updated. Then you record the exchange by measuring, first of all, the transaction at fair value. The resulting gain or loss gets recognized immediately. The asset received is recorded at its fair value, and the asset given up gets derecognized from the books. So if it's a depreciable asset, you will credit the asset at its cost and debit accumulated depreciation. This is true for both IFRS and ASPE. When there is no commercial substance, the exchange is instead measured using a book value approach. The asset being received is recorded at the carrying amount of the asset given up, adjusted for any cash received or paid. The gain resulting, if there's a gain resulting from the exchange, is not recorded, so it gets deferred. What if there is a loss? The loss treatment is different under ASPE as opposed to IFRS. IFRS, you don't recognize any immediate amount of the loss. So instead, the asset received is recorded at the carrying amount of the asset given up, adjusted for any cash. Any so if the asset being received, so why would there be a loss if the fair value of the asset received is lower? Well, what you do is you initially record the asset received at the carrying amount of what you gave up, but then you subsequently test the asset that you received and recognized for possible impairment. So that impairment test will catch up for any deviations. If there is really a difference, then that would get picked up in the impairment test if the asset fails the recoverability test. ASPE, on the other hand, says if the fair value of the asset received is less than the fair value of the asset given up, or rather the carrying value of the asset given up, well, then you got to record the asset received at its fair value, and you want to recognize the loss because the fair value of the asset received acts as a ceiling to the transaction. So this is an area where there is a difference in our treatment of IFRS versus ASPE. Taking a look at an example, so say we have a capital asset that originally cost $225,000 with accumulated depreciation of $95,000, market value $125,000, is traded along with cash payment of $75,000 for a new similar capital asset with a fair value of $200,000. So in this case, we notice that there is a significant cash component and you're getting a new asset. So certainly this results in a reconfiguration in the entity's cash flows. This exchange possesses commercial substance. So the transaction value, the fair value of the asset, the transaction value is essentially fair value of the asset given up plus cash paid. So that works out to $200,000. The accounting will be, you will debit the new asset for $200,000. You will derecognize the old asset by crediting its cost of $225,000, debiting accumulated depreciation of $95,000. We paid cash of $75,000, so credit cash $75,000. And to now balance out the entry, we need to debit a loss on exchange, $5,000. Why is there a loss on exchange? You can see that the original asset has a book value, 225 minus 95, $130,000 is the book value. However, the market value, the fair value of the asset given up is 125. So the $5,000 difference between the book value and the fair value of the asset being given up, well, that is picked up as the loss on exchange. So IFRS, we want to use the fair value of the asset given up. ASPE says use whichever value is more reliable. Here, essentially, you will end up getting the same outcome for ASPE. You will debit the new asset at $200,000, derecognize the old asset, record the cash paid, and debit loss on exchange, $5,000. Another example where there is no commercial substance. Similar facts as the earlier example here, though we're talking about the trade being done for a similar capital asset with a fair value of 135, the cash paid is 10,000. So in this case, you could say the cash component is pretty small and you're getting a similar asset. So it's not a newer asset. So you could say, well, okay, this particular exchange doesn't have commercial substance. So here now the asset received gets recorded at, under IFRS, the book value of the asset given up. Remember, the asset given up has a book value of 225 minus 95. That's 130,000. plus the cash payment of $10,000. So the new asset received gets recorded at $140,000. Under ASPE, the value of the asset, new asset received, should be recorded at book value of the asset given up plus the cash paid, but the maximum, the ceiling is the fair value of the asset received. So under ASPE, you would first calculate 140,000 book value of the asset given up plus the cash paid of 10,000. So that gives you 140,000. But then you ask, okay, so what's the fair value of what we received? The fair value of what we received is 135,000. ASPE says an asset cannot be recorded for more than its fair value. So, okay, well, fair value is 135. We'll have to go with 135 there. So how does the accounting look like? IFRS, you will record the new asset for 140, derecognize the old asset. So credit the cost of 225, debit the accumulated depreciation, credit cash for the $10,000 paid. And you will notice the total of debits equals total of credits. So there is no gain or loss recorded at all. IFRS, if there's no commercial substance, do not record any gain or loss. Whereas under ASPE, we recorded the new asset for at 135,000. We derecognize the old asset, credit the cash, but here you will notice the total of the debits does not equal total of credits. We have to book a loss on exchange, $5,000, to balance out the entry. So under ASPE, losses have to be recorded regardless of whether there's commercial substance or not. Only gain can be deferred under ASPE if there is no commercial substance. If there is commercial substance, no problem, record the gain or loss. The outcome is the same for IFRS and ASPE. So only when there is no commercial substance do you have that difference. IFRS says don't record any gain or loss. ASPE says you can defer the gain, but you must record any losses. So if the asset received has a fair value lower than the carrying amount of the asset given up, under ASPE, you will record a loss on exchange. Moving on to the last part here, discontinued operations. A discontinued operation is a component of an entity that has been disposed of, so sold off, or has been classified as held for sale and represents a separate major line of business or separate geographical area, or is part of a single coordinated plan to dispose of such line or area, or is a subsidiary acquired exclusively with a view to resale. There's a very formal definition provided in the standards. The standard under IFRS is IFRS 5. So a component of an entity basically has operations and cash flows that can be distinguished, separated from the rest of the entity. Right? So the practical outcome is the component would need to have been a CGU, a cash generating unit, or a group of CGUs while it was being used. So it cannot be a single asset. You cannot consider a single asset as a discontinued operation. It needed to be a cash generating unit. The cash generating unit is a grouping of assets that generate revenues, incur expenses. So it has to be a major line of business or operations in a geographical area. So essentially something that is capable of being operated as a standalone business. Here our focus is on assets held for sale. So assets held for sale, the held for sale category, it applies when the recovery of carrying amount will be through sale and not continued use. So assets that are intended to be abandoned can't be classified as held for sale, right? Because they're not ultimately going to be sold. The classification results in a shift in measurement and presentation that takes place before derecognition, right? So the held for sale classification is the outcome of certain criteria that have to be met. It's a conscious decision. A non-current asset or a disposal group that is held for distribution to owners, it can be classified as held for distribution, but it's not held for sale, but its conditions are similar to held for sale. So if, let's say, assets, a group of assets are meant to be essentially distributed to owners, like, given away, given back to the owners, they can't be called held for sale, but the criteria for such classification or determination is similar to the criteria for held for sale. So what are the criteria for held for sale? In order to be classified as held for sale, the asset has to be available for immediate sale in its present condition. And sale must be highly probable within 1 year. And that is supported by there being management commitment to a plan to sell. There's being an active program to find a buyer and complete the plan of sale. The asset must be actively marketed at a price that is reasonable relative to its current fair value. The sale should be expected to be completed within a year. Now, sometimes there can be relaxation of that for delays that are beyond control of the company, but the company's management is committed to complete the sale, and that the plan is unlikely to be withdrawn or there are any significant changes made to the plan. So that's not likely to happen. So all of these criteria have to be met, okay, for the asset to be classified as held for sale. And it's important to keep in mind, completion must occur within a year unless the delay is caused by events that are beyond the entity's control and there is sufficient evidence that the entity remains committed to complete the sale. If the assets meet the held for sale criteria, then you measure them at the lower of carrying amount and fair value less cost to sell. If the carrying amount is lower than fair value less cost to sell, well, we really have to do nothing. But if the fair value less cost to sell is the lesser amount, we need to write down the asset for the difference, and that write down is recorded as an impairment loss in P&L, profit and loss. Let's take a look at an example. So Glider Inc. makes high-performance bikes. This year, Glider replaced an old machine with a new, more advanced model. The old machine is still functional, could continue to be used in production. The machine was removed from Glider's factory on August 31st and is now in storage. Before moving it, Glider conducted all necessary maintenance on the machine. The machine originally cost $120,000, has a current carrying value of $72,000. Depreciation wasn't recorded after August 31st. So that's something that I didn't mention. So once an asset has been classified as held for sale, you no longer depreciate it. The machinery is being advertised on industry platforms for $75,000. Selling costs are expected to be 8% of the sales price. Management has not yet received any offers to purchase the machine, but similar machines have typically sold within a few months for prices close to $75,000. Glider reports under ASPE and has a December 31st year end. So first, we have to assess if the held for sale criteria are met. First criterion, the asset must be available for immediate sale in its present condition, subject only to terms that are usual and customary for sales of such assets. This criterion is met because the asset is still functional, it is well maintained, it's in storage, can be shipped out to the buyer right away. In addition, the asset must be expected to be sold within 1 year. And that comes with 5 other factors. So management must have committed to the plan to sell the asset. That's met. The asset has been removed from the factory. It's in storage. An active program to locate a buyer and other actions required to complete the sale plan have been initiated. This is met as well. The asset is being advertised on industry platforms. The sale is probable and it's expected to qualify for recognition as a completed sale within a year. That's met because similar machines typically sell within a few months based on the facts provided to us. The asset is being actively marketed for sale at a price that's reasonable in relation to its current fair value. This is met because the asset is being advertised for $75,000. The other similar assets have sold pretty close to this amount. And then lastly, the actions required to complete the plan indicate that it's unlikely that significant changes to the plan will be made or that plan will be withdrawn. We don't have any indications to the contrary, so we'd say, yep, that's met as well. So once we've established that the held for sale criteria are met, then we would reclassify the machine to held for sale. And on reclassification, we shall measure it at the lower of carrying amount. So carrying amount is cost minus the accumulated depreciation. In the case it was given 72,000, or fair value less cost to sell. Now the fair value, well, if we go with $75,000, if that is close to the amount at which we are expecting or we have listed the asset for sale, if we assume that that is what its fair value is, there is a cost of sale, right? There's an 8% charge for sale. So 8% of 75,000 works out to $6,000. Fair value less cost to sell in that case becomes 69,000. 69,000 is lower than 72,000. So that means there is impairment loss resulting from the reclassification, $3,000. The journal entry to record the reclassification will be: you debit the assets held for sale, 69,000, derecognize the existing asset by debiting accumulated depreciation and crediting the cost. So credit the machinery 120,000, debit the accumulated depreciation for the 48,000, and you debit an impairment loss for the $3,000. Total of debits should equal total of credits. Now, once an asset has been classified as held for sale, we stop depreciation. We no longer depreciate. And that was something that Glider in the earlier example has done. They've not been depreciating the machine after it was moved into storage. If there are subsequent changes in fair value less cost to sell, let's say there's a drop, well, then that should be recognized immediately in profit or loss if the decline is below the carrying amount. However, increases can result in a recovery of impairment losses previously recorded. Under no circumstances, though, are we allowed to write up the asset above its carrying amount before being reclassified as held for sale. What if there's a change in plan? If the asset no longer meets the held for sale criteria, well, then we need to bring it back into the fold of wherever it originally belonged, let's say property, plant, and equipment. We'll measure it at the lower of the carrying amount as if it was never classified as held for sale. So we'd have to consider depreciation that would have been recorded in the meantime and its recoverable amount at the date the decision was made to abandon plans of selling. The related adjustments go through profit or loss as part of continuing operations. In terms of presentation, assets that are designated as held for sale must be shown separately on the statement of financial position. If there are liabilities of an asset disposal group that is designated as held for sale, the liabilities are shown separate from the assets. You don't offset the assets and liabilities in presentation. So show the assets separately and the liabilities separately. IFRS you will show as current because the definition requires the sale to be completed within a year. Under ASPE, since we don't have an equivalent held for sale category, you would continue to show the assets on their, so if you're talking about machinery, the machinery will be shown as a non-current asset under PP&E, non-current assets. It's not PP&E anymore. It will be shown as a non-current asset because the machine originally was a non-current asset. So what are the final takeaways for us from topic 7, accounting for assets? Asset accounting follows a life cycle approach. We have to consider the asset classification, recognition and measurement, subsequent measurement, and then take care of the derecognition. The classification drives accounting outcomes, including which measurement model is used. So recall we looked at cost model, revaluation model, fair value model, when expenses are recognized, and how impairment is tested for and treated. Initial measurement is cost-based. Cost, though, extends beyond simply cash paid. It considers other things such as directly attributable costs, deferred payment plans, etc., etc. Subsequent measurement balances the systematic cost allocation, so depreciation, and recoverability through impairment. Although IFRS and ASPE are fairly aligned in most cases, their differences do matter, particularly for which measurement models end up being used. So ASPE is much more limited in that context. And the loss recognition when asset exchanges occur, and we saw that in the example relating to commercial substance being missing. So when there's no commercial substance, we cannot write an asset for more than its fair value. Okay, so that concludes this last final installment of our discussion on accounting for assets. Thank you very much for watching. We will be doing a lot of examples in class, and in subsequent topics, we will be looking at specific issues relating to specific assets. This was more of a high level acknowledgement of how assets ought to be accounted for. We are going to assess individual accounting issues for individual asset categories in future topics.